Good day, fellow investors. Warren Buffett's letter to shareholders is out, and I have prepared 7 lessons and 4 warnings from that letter, and through those we'll also give you the answer on why Berkshire is a stock to buy now. Let's immediately start with number 1. Who is the typical Berkshire shareholder and what kind of business it is? Buffett compares it to buying a farm or having a rental property and avoiding purchasing lottery tickets or hot stocks. The first lesson is thus about compounding over the long term and managing risk, not losing money, which is then the essence of value investing, and Warren Buffett nicely puts it on top of the letter by explaining for whom these Berkshire stocks are. And then he immediately discusses the earnings, and you can see the earnings: 90 billion for 2021, lost 23 billion 2022, 96 billion earnings in 2023. However, these accounting earnings are worse than useless net income figures, but unfortunately the internet and the media immediately transmits those earnings, and you can see on Guru Focus the Berkshire Hathaway PE ratio today is 12, but that is not correct because Warren Buffett also adjusts things by calculating what he calls operating earnings. I say what he calls because he includes everything in those earnings, even taxes paid by the operating businesses. And the story is much different than the above. Earnings were 27 billion in 2021, growing to 31 billion in 2022, and now to 37 billion in 2023. And the primary difference is, of course, he likes to exclude unrealized capital gains or losses that at time can exceed 5 billion a day as the stock market moves. And the funny thing is that before the new accounting rules, before 2018, these operating earnings were the normalcy for reporting. Thus, lesson number 2, don't focus on top-line numbers, always search deeper into the bottom line value. And on top of these operating earnings that include the dividends from the stocks owned, those don't include the actual earnings from those stock owned. So there is a few more billion in hidden earnings there if you want to know Berkshire deeper. Let's take those earnings to make a Berkshire valuation, and you can immediately see that the P ratio is not 12 but actually 24, because if I divide the market capitalization of 905 billion with 37 billion of earnings, I get a price earnings ratio of 24, in line with the market, but I still think that Berkshire is a better buy than the S&P 500, and you'll see how the story continues on why is that. There is a comment on the economy, how he has been investing since 1942, but all you need to do is sit quietly, invest, listen to no one, and that's all you need to know about the economy. Further, lesson 4. Something that most investors have been avoiding focusing on lately, but it is the essence of value investing and Benjamin Graham, and that is net worth or book value, how do you prefer to call it. And Warren Buffett discusses how Berkshire's net worth is 561 billion, which makes 6% of the net worth of the S&P 500 of 8.9 trillion. That is Berkshire, but the market capitalization is less than 3% of the S&P 500, thus compounding over the long term. That net worth should go higher and higher, and that's his focus. Do not destroy net worth, because if you own a business that compounds over time, it's automatically normal that that net worth book value should be increasing over time. Today, all businesses are destroying that book value through repurchases because those repurchases are made at 10 times book value. Of course, those are different businesses and everything is about profits, but there is the fact of eternity incorporated in Berkshire, which can be questionable with many of the businesses that are pushing on buybacks today. Lesson number 5. He says that Berkshire as an investment should do a bit better than the average American corporation, and much more important, essential, should also operate with materially less risk of permanent loss of capital. And this is key, because if you compare the return on equity from Berkshire this year, around 6.5%, the 37 billion on the equity of 561 billion, compared to the S&P 500 increase in equity from 8.9 to 9.5 this year of 600 billion on 8.5 trillion, you can see that the returns in these good times are similar, so a little bit even lower for Berkshire, but the key difference there is that Berkshire is built to last. You have insurance that can do good also in weaker economic times. The other S&P 500 will not do the same. There are essential businesses like utilities, railroads, diversified, consumer discretionary, whatever. Plus, there is the huge pile of cash and Berkshire's name that makes the difference. And whatever comes in the next 10-20 years, economy, whatever, Berkshire is likely the one that will survive whatever comes ahead. Many other businesses will not, and therefore Berkshire is much better from the rest, because at equal returns, the risk is much, much smaller, which is the essence of investing, because it allows for long-term compounding. Compared to other businesses that are focused on maximizing next quarter earnings to impress Wall Street. The first warning, he discusses that his weapon is taking advantage of market irrationalities, and that now, even more than in the past, for whatever reasons, markets exhibit far more casino-like behavior than they did when Warren Buffett was young. The casino now resides in many homes and daily tempts the occupants. That is the story of the current market. The first warning, thus, don't bet on stocks, invest for the long term, and one way to invest for the long term is Berkshire Hathaway. How to invest for the long term? First, ask yourself whether you are risking permanent loss of capital or long-term bad returns if you buy the hot stock now at these valuations. So the rest is find good investments that will keep compounding and sit tight, and a couple of good decisions during a lifetime. Avoiding serious mistakes is all you need to do. This leads us to the next warning, that there are good times like now, but there will also be bad times. When economic upsets occur, as they will, even if nobody thinks about economic upsets anymore, Berkshire will be there to function as an asset to the country, as a hedge, because they have the cash to buy assets at a discount. But keep in mind this warning, bad times will come, as they always came in history, will come in the future, and the key is that we are prepared. To quote Buffett, such instant panics won't happen often, but they will be there and they will happen. Thus, lesson number 6, be prepared. We did not predict the time of an economic paralysis, but we were always prepared for one. And that's the key question you have to answer. Am I prepared for whatever comes next? Be it a depression, recession, or economic growth forever, we just have to be prepared for whatever so that we can keep compounding over time. That's the key. Even if it sounds crazy in this Wall Street environment of next quarter growth, next year growth, prepared for everything so that you can allow that force of compounding. Going to Berkshire's earnings, insurance did really good during the year, much better than the 2022 loss, but there will always be ups and downs in insurance. Higher interest on US treasuries led to increased profits from investment income. railroads stagnated a little bit, plus there are huge depreciation and replacement costs to just keep it running. So not a great business, but we'll discuss that also in a moment. Utilities are starting to be under pressure by states and governments, fires, so that is also not going well. The other businesses are pretty much stable. And here we have warning number 3. Not all investments will work as planned over time. Maybe the utilities and energies are now facing headwinds that haven't been there 10-20 years ago as Warren was building this, and he also warns that it might end up badly, but the counterpart for him is that all the other businesses are printing cash, and he will simply allocate capital there where it is better to allocate capital, because lesson number 6, it is all about the price. And on Burlington Northern, not a great business because it's highly capital intensive, but if you purchase it at the right price, you can get a good return. And Warren Buffett bought it in 2009. By 2015, he got all his money out in dividends already. So it is, again, a risk-free investment for him because he purchased it on a low price. And whatever he gets now from that is a bonus. Plus, he can always sell it for good money in the right economic environment. Now, lesson 7 that's also warning are buybacks. You can see here that Berkshire lowered the amount of buybacks in the last 2 years, and that is because the stock went up, up, and up, and Warren Buffett doesn't think that the best thing to do now is to buy Berkshire stock. And therefore, the buybacks are relatively at a low level. Of course, if you call him, you say you have 100 million of Berkshire stock to sell, he will buy it and maybe a little bit more, but not much compared to lower stock prices. And now you might ask, why would I buy Berkshire if Warren Buffett isn't aggressively doing buybacks? Well, Berkshire is a buy, but it depends on who you are and how you look at things. Before discussing that, of course, Berkshire buybacks are discretionary because they depend on price. All stock repurchases should be price dependent. What is sensible at a discount to business value becomes stupid if done at a premium. Now, with all of Wall Street focused on buybacks, do we buy at a discount or at a premium? Time will tell whether Wall Street is stupid or not. Hope you enjoyed this, and now it's time to answer the question, is Berkshire a buy? And it is an absolute buy. If you are an American investor or you want exposure to the US dollar, you want long-term safety in the American economy, and you want a good, okay, not incredibly high, but good, stable, long-term return that will likely compound over time. If that is you, that you fit the description of a Berkshire shareholder and just keep investing your money time over time in Berkshire, and over 10-20 years, you will do fine. Because a similar return to the S&P 500, but much, much less risk, I find Berkshire 5 times better investment than the S&P 500. However, if you are asking the question, is Berkshire a value investment now? And that depends on the price purchased, then I would say not now. Because a P ratio of 24, when we add the hidden earnings 20, is on the higher range for Berkshire. You want to buy Berkshire at those times of economic panic, at those times when insurance is not doing good. And maybe you remember in March of 2020, I told you Berkshire will not be long at these prices because then the P ratio was 10 compared to the 24 of now, which is a huge difference. Maybe that will come again, maybe not, but that's why We follow a lot of stocks, and then we see which ones are expensive or not. Thanks, Warren, for letter. Great lessons as always. And the key is that you see whether Berkshire fits you or not.